All right. Welcome everybody to Minus Investing Live. Hope you're all having a good Saturday afternoon. Hope you all had a good first week of the year as well. First week in general, also first trading week, of course. Right off the bat, we have the market kind of, for the most part, meandering downward over the course of the week. Slight bump up towards the end there, but for the most part, pretty down week. You can see right here, we reset the year-to-date chart on our dashboard right here, and right off the bat, we're already about 1% below the S&P 500 for the year. Hopefully, that's definitely more of a fluke and not a beginning of repeat performance from last year. But hey, is what it is. The market's already down about 1.5%. We're down about 2.5%, and the small cap and total return index is down 3.75% already. So pretty interesting with that off the bat. We do have some changes to the portfolio as well. I did start off the year making some new additions to the portfolio, which we'll kind of be discussing some of the thoughts behind some of those over the course of the discussion we're going to have here today, which is that we're going to be kind of continuing our discussion today surrounding a lot of the pricing methods I've been using for comparing lots of other companies on a relative basis to other companies within their industry, within their sector, their comparable fields in different ways, trying to determine on a relative basis whether or not companies are cheaper than others. And I've used this method as sort of a screening method as well. So you can use this as a way to kind of bolster your valuation by saying that yes, on a relative basis to similar companies in a similar industry, they're not only undervalued, but they're also underpriced. You can also use this method to say, okay, well, let's go look and see what are the underpriced companies within a certain industry or an area, and then go check those companies and see, well, are they also potentially undervalued as well? So you can kind of go both directions with it. And I did a ton of that this week, and so I'm going to be kind of covering some of the things I did with that. But anyway, the two companies that I did add to the portfolio, which you can see right here, are two of the smallest positions in our portfolio right now, but we'll see if they start to grow, especially considering you can see some of the potential sizes that we have for them. But we have NGD, which is New Gold, a Canadian gold miner, as well as Silvercorp SVM, which is a Canadian silver mining company. Both of them have kind of different theses around them, and they're both pretty interesting opportunities themselves. One more than the other, but one of them also has more risk than the others, so that's kind of where I think it balances out between them. It's like one of them has a much higher opportunity, I think, to them, but also some potential risks, whereas the other one has less risks. In fact, it's one of the reasons I like it is because it's a low risk play, but maybe it doesn't have quite as stellar of returns. But either way, they both ended up looking extremely underpriced, and so I ended up finding them to also be undervalued. And then with a little bit more of research into their production profiles and the geographic regions in which they mine and operate and the companies that operate them, I decided I wanted to take positions in them because while they are gold and silver miners, and anybody who's been watching my channel would know that I've definitely been paying attention to those spaces for quite some time, especially the gold mining space. And I already have one gold miner in my portfolio, and I've been looking for other opportunities to get more gold exposure. And then silver, I haven't had exposure to in my portfolio, but I have wanted to get some silver exposure for a while, and just hadn't been able to find the right one. So finally happy to have found those ones, so to speak. But like I said, we'll get into some of the specifics with that later on, once we get to kind of the further discussion of how we kind of got to those opportunities in the first place. But the point is this pricing method for screening for stocks has been very, very fruitful. It's been a ton of work over the course of the week. I've really put in a ton of work, but I have lots of stuff that look like good opportunities right now that I'm looking at, as well as I have a really large pool of stuff to continue sifting through. So far it's been very, very fruitful in terms of, I think, finding opportunities and potentially really good opportunities. So we'll see how good those opportunities actually end up being in our portfolio in terms of our returns here. So you know, it looks good at first, but we'll see if it continues to be that way going forward. But the point is this could end up being a very useful method going forward, as kind of like a process for finding opportunities and then getting them into the portfolio. It's like it's one thing to have good methods for valuing companies, but finding the opportunities in the first place is always a very tricky business. That's always been a very difficult part of this. So anyway, enough of that. Moving on from that, we'll kind of come over. Oh well, so come down here. I don't think there's nothing necessarily to speak about the specific company returns necessarily at the moment. I already talked about the year-to-date returns and the new additions to the portfolio. Oh, well, I will say one other detail. Over here in the strategy pie, which I normally don't comment on too often because it doesn't usually not much to say about it. I do have this tiny slice right here for pricing slash workouts, which are companies that I haven't necessarily put a full revenue model and or expense model together for the valuation, and instead just kind of a basic valuation that seems to indicate some pretty good value, along with them being very cheap on a pricing basis, and or them being part of a corporate workout, like a merger or arbitrage, so to speak. Those are what I consider a pricing workout, and I have them categorized as a different kind of strategy right here. And I'm usually willing to invest in them under some slightly different circumstances. For example, I have Spirit Airlines, which is a company that I actually think is extremely overvalued, but it is a merger arbitrage, and so I'm willing to ignore how overvalued it is because of those reasons, as well as Jackson, which is a financial company that I've had for some time that I invested on a pricing basis. My valuation seemed to indicate the value was good, but I didn't really do the strong research on the company specifically to really do a thorough analysis of them. I just did some worst case assumptions and found it to be pretty good. But on a pricing basis, relative to other companies within their industry, they looked really, really cheap. So I was willing to do kind of a more short-term swing trade on them, so to speak, on a pricing basis. So that's kind of an example of what I mean by a pricing slash workout investment opportunity. I mentioned this because I have categorized both NGD and SVM also as pricing slash workouts. So the pricing slash workouts as a percentage of our full portfolio is now 1.8%, which, we want to keep that a relatively small portion of our portfolio. But the point is we are willing to invest in some things that are a little bit off of the pure valuation play, so to speak, under certain circumstances. But in terms of considering them both pricing based investments, I would say that when it comes to commodity companies, I honestly, if you've already done the work on that commodity a little bit before, it becomes very easy to adapt the work you've done on that commodity to another company within that same commodity space. All you have to do is learn about the production profile, and then you've already done probably some analysis on where you expect prices to go in the near to long term over the course of the investment. And so I mentioned that because that's true for NGD and SVM. I do have predictions for gold and silver, which is relevant for both of them. And so the point is it's actually pretty easy to put together some projections over what I think the revenues are going to do over the course of 5 or 10 years. So I didn't really put together a full model, but I did actually put together some basic models for especially SVM. But NGD, I didn't do as much of it, but that's more of the pure play gold operator, where SVM is a little bit of a mixture situation, which we'll talk about a little bit more later anyway. But I just kind of wanted to comment on that because there is this kind of bifurcation between different types of strategies in my portfolio, and I like to keep them separate in my mind, both in terms of how I act on them as well as how I talk about them. So anyway, let's come over to the value dashboard, which that's the secondary page. Let's come over to the main page, which I commented already on all the changes last time we had a live show. I think I had commented that I needed to make some changes to the AD line calculation, which I did make those changes over the course of the last week. I changed it so that it corrected the problems I was having, but also I previously had the AD line showing the change over the course of a month over month change for the AD line, and I've changed it now to be a week over week change. I want it to be a little bit tighter, a little bit more of a short-term signal, so that it gets a little bit more of an immediate kind of signaling, but still 1 day is a little bit too short. So I went with a week, just so that that's clear. So when you're looking at this, you understand what it means. High distribution, that means a better than average week over week change for that particular company. That's what it means in terms of a high distribution on the AD line indicator right here, and high accumulation, the opposite. But anyway, no other major changes to the main page of the dashboard right here, other than to comment that there is one new company on the dashboard, which is this company right here, PINC, Premier Inc., which is a healthcare supplier, a supply chain operator, as well as a technology supplier within the healthcare space. And this is another company that I have identified over the course of the last week with a lot of the pricing analyses that I've done as a method for sorting through companies. So I've already managed to get it onto the main page of the dashboard right here, which would imply that I've actually put together a full model for this company already. So I identified this company. I already did a full model for it after finding it to be seemingly a pretty good value along with significantly underpriced. So I was like, well, let's do a full valuation for this one. And then I've already put it onto the main page right here. It's possible that I'll do a video for this one at some point in the near future. And hell, it's even possible that I'll invest in it at some point in the near future. As you can see right here, I find it to be about 24% undervalued, 11% returns, 31 percentile in terms of all the total projections that I've made. If I could get it down to that 25th percentile or even down to maybe a 12% COGR, I would maybe pull the trigger on that. So it's already pretty close to maybe being a startable position. It's a pretty interesting company, especially like I said, it's a kind of a supply chain organizer and a kind of a middleman of sorts for the healthcare space, which kind of surprised me why they have such pretty strong margins, all considered for that type of company. And I think it comes down to just how much technology that they use in their recommendations and all the software that they provide for their clients. Pretty interesting company, and I think it could work well with the kind of more healthcare based themes that we have about the next decade in the retiring boomers and the need for a more expansive healthcare system. Like I said, I might make a video on that one at some point in the future, so I don't really want to get too much into it right now, other than a comment to say, like I was just saying a moment ago, not only do I have 2 new companies in my portfolio, but 1 new one on the dashboard. As I was saying, the process has been pretty fruitful this week. We've already been making some actions, doing some things, getting some things in order. And I have other companies that I'm looking to make some models for pretty much as soon as I'm done with this live show. The plans for the rest of the day is probably to work on another model. So really trying to start cranking some stuff out. The goal was to also ideally identify, small companies that are not highly covered, that a lot of people have never heard of before, because that's often where a lot of the better opportunities are. The catch-22 to that, of course, is that I am in the business of making content. And so obviously if they're not very well heard of companies, those aren't necessarily the best the high click, high view opportunities necessarily. But if the company does really well, if it performs really well, then maybe later on down the road, people will eventually click on it. That's kind of the kind of mixture between it. So there's companies that are popular right now, and then there's companies that are popular later on down the road after they performed really well in terms of viewership. And then there's also just total surprise ones out there. But the point is, I didn't really see too many videos out there covering this company. So if I make a video on this one, it could be one of the only videos out there possibly on that front, which has its benefits, but also has its negatives. So anyway, let's come over to the secondary page where we have a lot more of the companies that I've identified over the course of the last week, because these are the ones that I don't have to have made a full model for. If I find it to be significantly underpriced, I can just do a basic analysis. And then if I think that the value looks reasonably close to fair value, or even already looks significantly under fair value, I'll throw it up here so I can kind of pay attention to it. And these are the ones that I'm kind of like almost ready to make a model for, but haven't quite gotten around to making a model for it yet, so to speak, or I'm paying attention to them. And then obviously, like you can see right here, companies that I already have are ones that I was just talking about, pricing / workout related investments on my portfolio dashboard. Those are the ones that are marked purple right here, are the ones that I own, which the ones that are marked purple here are the ones that I own on this page too, but there are a lot more of them because that's the main valuation page. But anyway, the point is there's a lot of other companies right here that look to be potential opportunities if you're looking closely. I already talked about SVM and NGD a little bit. Like I said, we'll talk about them a little bit more later on, but you can see like right here, both of them look pretty good. But there's also RGP, Resources Connections, as well as Hydric and Struggles International, HSII. Both of those look to be in kind of the employment services and kind of consulting services industry. So I haven't really done too much analysis on them, but you can see like both of them appear to be pretty interesting, pretty high opportunities available to them. I'm very interested to get into the Hydric and Struggles one. I will say that I'm actually kind of doing them in reverse order of the amount of value that I see right here. So I already built the model for Premier, and you can see that one has about 24% of upside, which before I did it, I'm pretty sure it was around 20 or something like that. So I'm almost going in reverse order of the amount of value that I see right here. And the reason why I'm kind of doing it that way is because I don't want the opportunity to disappear before I get an opportunity to do some solid analysis on it. And in terms of these companies that just have the pricing thing going for them, for the commodity companies, I was willing to maybe pull the trigger on just, like I said, starting an investment on that. But for these ones, I don't know as much about their industry, so I'm not necessarily going to pull the trigger on them without doing a full model for them. In the same way I like it did only did kind of half models for New Gold and Silver Corp. And then I didn't even do a model, like I said, for Jackson. That one was just so cheap that it just seemed like it was a screaming opportunity. And that one panned out really, really well. And then Spirit's a totally different story altogether. But you know, like I said, there's other opportunities right here that are very, very interesting. So I already did the Premier one. I will probably be working on some stuff related to resources and Hydric at some point in the near future here. And then I may actually, like I said, put together a more full, robust one for Silver Corp. I already did kind of like a half model for Silver Corp, a very, very simplistic one. But if I did a much more thorough one, and the reason why I do that one is because that one actually has kind of an interesting story and transaction to it. With some opportunity to it in the future. That is the one that, like I said, has opportunity but also some risk associated with it. But that one I think could also be a very interesting video. Probably not a very popular company to cover necessarily, but just the opportunity itself is so interesting that I feel it would be cool to have a video out there just in case it did come to pass, because then it could be like, hey, you made a video on that way back when, and all that opportunity. But the point is one thing you can see in common with these companies I'm talking right here is most of them are, well, not most of them, they all definitely are very, very small companies that are very, very uncovered, not very well-known companies. So obviously I've been focusing a lot on smaller companies, you can see right here, but there is plenty of other opportunities to maybe look at using that pricing method, looking at larger companies. The point is I just think the larger companies have a much higher chance of being overvalued from the get-go. So I haven't really been looking at them much to begin with. Anyway, come over here to this notes page where I've often kind of kept just kind of like jotted down some tickers that people have mentioned to me, or other little things that I want to look at later. It kind of got turned into this research page for while I was doing all of this pricing analysis, and this is kind of like the summary of everything that I did right here. And now I'm going to kind of get into it and kind of describe everything that I kind of went through. So after I kind of showed you guys some of the pricing analysis last week and the week before that, I even commented on it. I can't remember exact specific points, but there was points where I said, oh, well, the reason why we're getting some of these showing as being significantly underpriced relative to others is some of them are very obviously within the same industry. And that's because on an industry basis, these metrics often show very huge differences. So often when you do a pricing analysis with fundamental metrics, you do want to do it on an industry basis. So I kind of like was listening to myself and decided, hey, well, we'll actually kind of take that to heart. And then we'll actually go on an industry basis and do a lot of these analysis ourselves. So what I did is I went and found the lists of the companies that are part of the sector groupings within the S&P 500, and I actually started doing some pricing analysis based off of sectors within the S&P 500. And after I did a couple of them within the S&P 500, I was like, well, I'm mostly just covering some really large companies, and these are mostly going to be overvalued companies in the first place, so these probably aren't going to end up actually giving me some really good opportunities. So why don't I also go find some small cap ETFs as well, done on by sector, and then also do some pricing analyses based off of that. So over the course of last week, I did a whole ton of different pricing analyses. Let's see, 18 in total that are non-overlapping in any way whatsoever. As you can see right here, there's I didn't do every sector. As you can see, there's no utility sector, there's no communication sector, but I did the vast majority of the sectors: industrials, healthcare, energy, discretionary, defensive, materials, tech, real estate, financials, and with on average about 50 companies within each grouping, though as low as like 28 in one of them and as much as like 77 in another one of them. So a little bit different grouping that, but 454 companies out of the S&P 500. So, you know, the vast majority of the S&P 500, and then the small cap ETF groupings, the same industrial groupings, though on average they had actually 63 companies within each grouping, as much as 110 in one of them, as low as 28 in another one of them. So a little bit more small caps that we did pricing analysis for than the S&P 500, but that's still 564 companies. And then I also did, because the same website where I was looking at the small cap ETFs, which was primarily Invesco ETFs, in case you're wondering which specific ETFs I was looking at, was Invesco sector ETFs that I was looking at. They also had some specific industry ETF groupings, and some of those industries were ones that I was particularly interested in, and I knew that some of those differences would make a difference, especially so I wanted to get those in there as well. In particular, they had an Invesco Global Timber ETF that I wanted to look at. which I'm very interested in, the timber and lumber space. And then gold miners, silver miners, and copper miners, I went looking for ETFs for those ones as well. I had already covered a lot of those companies in the materials sector groupings, but like I said, those, even on a sector basis, there could be significant differences within individual industries. And so I was like, well, because I'm doing particular analysis on a lot of commodity companies, I wanted to actually get those kind of separated out a little bit right there. So the point is, all together, that's on. Oh, and then I also did find a bulk building and construction ETF, and I kind of particularly wanted to look at that one as well. Anyway, that's another 173 companies, but some of those overlap within the companies right there. So if I separate out the doubles, it ends up being another 115 companies. So all in together, I did pricing analysis. What is it right here? We got, what is it, 5 plus, what was it, 18 before that we had right here. So that would be 23 different groupings of 1,133 companies. The 1,133 companies grouped into 23 different ways, and all those companies then had pricing analysis done on them in the same 10 multiples, 10 fundamental metrics method that I've been talking about for the last couple of weeks. And then this list that you see to the right is essentially the best of the best out of them, which ends up being a pretty long list all considered, because again, we're talking about 1,100 companies, and best of the best, what I mean by that is 1 standard deviation above average level pricing, and then 2 standard deviations above average level pricing is the ones that I have stars next to. It ended up being about 10% of the companies that have the 1 standard deviation. It ended up being about 1.5 to 2% of the companies that have the 2 standard deviation. So a pretty significant amount of companies nonetheless. Well over 100, I think it was closer to 150 companies had 1 standard deviation, and it was like a dozen, 20 companies, something like that had 2 standard deviations. So I've been looking at a lot of the 2 standard deviation ones first, and then I've been kind of like diving into some of the 1 standard deviation ones, and I've been kind of going somewhat blind about it, but also kind of picking and choosing a little bit, and ignoring certain industries as well. For example, I've been ignoring the financials. I'll get to the financials later, but for the time being, I've been ignoring the financials. Also been ignoring energy. I was like, I'll do some of the energy ones later, except for some of the energy equipment ones. But I was paying attention to the gold ones, the silver ones, look at the consumer product ones, financials, industrials, or like I said, not financials. But like I said, a whole ton of companies, and I've been kind of going through them. I've already removed the ones I've already gone through. So this is the list of ones that I still have to actually go through for the record. That's like the one thing that has to kind of be kept in common here. This is the folder of all the different pricing sheets. Like I said, it's very similar to the kind of same method that I had talked about for the last couple of weeks. Here's the S&P 500 health grouping, which this is a good example of an industry where there's actually going to be significant differences even within the sector, because the health is going to include biotech, but it's also going to include health insurance, some health insurance anyway, but it's also going to include like other things like that. So it's like pretty significant differences within the companies, but nonetheless we're still working with it. We can only do as good as we can get, but we were pretty happy with the pricing analysis we got. The spreadsheet needs to be reset. But the point is each spreadsheet maybe only gave us a couple companies to contribute to that total list. The ones that are marked green are the ones that are 1 standard deviation and above, and the ones that are marked purple are the ones that are 2 standard deviation and above. And so I did it on each spreadsheet basis, and just kind of looked at what was the stats for each of those, which companies stood out as being particularly underpriced relative to their sector within that group, and then it got thrown onto the list. And like I said, this is the S&P health grouping. Here's the small cap health grouping, which is a little bit larger. Small cap groups tended to be larger, as I was kind of saying. So there's maybe a few more opportunities within that. And then this is where I found, for example, Premier. Premier was one of the ones that was 2 standard deviations underpriced within the small cap health grouping. Now it's health, like I said, so there's some wide differences between multiples within that group, which could explain some of those differences, but nonetheless, the valuation ended up looking pretty good. And it's not like every company I look at that's underpriced just suddenly, oh, for sure, that one is definitely going to look like it's a good value too. I don't want to make it seem like, oh, it's just that easy. It's just find things that are underpriced and then they're undervalued as well, because there's a pretty large graveyard of companies that we didn't actually find to be good values. If I come back over to this list over here, how many companies do we have on this list? 13 companies on this list, and about 5 of them we kind of already knew about. So it's like 8 companies that we've added to this list, which are ones that seem to be of reasonable value or are of decent value or are reasonably close to that value. About 8 of them out of let's see, how many folders do we have right here? Oh, it just 41. So 8 out of 41 looked like they were of reasonable value or of decent value, just to give you a sense of how much success versus failure there were. So there's a lot of companies that I did this kind of for, and then I found not to be of a particularly good value. But the point is 8 out of 41 is not bad. I'll take that. It's a lot of work doing some kind of basic valuation work on 41 different companies. But a lot of the changes that I did to my DCF template, as well as my dashboard over the course of the last month that I've talked about over the last several shows, a lot of those changes have made my workflow a lot easier to get through. So the point is I can do all the prep work that's required to kind of even just start looking at a company. I can do that now in like 5 minutes, when that used to like a year and a half ago, that used to take like an hour and a half just to do that kind of like early processing work. Now it takes like 5 minutes. And then I can actually like look at the company, which can take anywhere from, I don't know, 10 minutes to half an hour, depending on how much like effort I want to put into a basic valuation. And so therefore I can kind of get through one of these bad boys in half an hour. And so this is like a couple days worth of work that you can see right here. And like I said, yeah, maybe it ends up with 8 out of 41. That's like 20% of stuff that we found to maybe be a reasonable value or close to value, or actually are a significant value. And then obviously the ones that are actually undervalued out of that 8, it appears to maybe be about half of them or something like that, right? Because we do have a handful that I put up here that are appear to be overvalued, but are close enough that maybe we want to keep an eye on them. And that's kind of like why they're there in the first place. So this is kind of what I mean by fruitful. This is pretty fruitful. 1,100 companies to look at. 1,100 companies. We sorted it down to the top like 10 to 12%. That 10 to 12%, then you got, which was about 150 companies or something like that. We even had kind of an early 20 to 30 or something to look at first out of that 150, but then we can still move on to that 150. And then through that, we ended up with, like I said, we've already made it through about 41 of them, and we did that in a couple of days. So, that therefore we could have several days more of work that we have available to do for us, which, by the way, if we want to keep doing this, which we do want to keep doing this, we kind of want to do it relatively quickly, because pricing is kind of a time sensitive thing. The analysis is only as good as the day I did it. So every day that goes by since I did the pricing analysis, the further all these companies get away from those prices, and therefore the less reflective of it is of reality. And then also more fundamentals come out, and therefore the statistics start to change as well. So point is it's kind of like a snapshot in time kind of approach. So the point is over the course of the next week, maybe I can get through another half of this list, and then maybe I'll just kind of discard the other half of the list as companies that I'm less interested in the first place. But I could repeat this process every 3 months or something like that, right? And then, as I kind of already said, I already found 2 companies to add to my portfolio. One other company that appears to be somewhat undervalued, that is close to maybe being buyable, that I put on the main dashboard, as well as a couple other companies that I'm going to look at this week. So pretty good work, pretty good work, all in this week. Lots of work. Been very, very busy, but it's been very, very productive, and it's actually felt like it's going somewhere, which is cool, because getting into the start of the year, definitely kind of looking at my portfolio and being like, okay, I'm really happy with some of the positions I have, but some of them are starting to get towards the point where there's not necessarily going to be too much more steam in some of those positions, and at some point or another you might want to have to replace them with something else. And then I have had way more cash than I've generally have wanted for quite some time. Obviously that was one of the bigger drags for me of last year, and so a huge focus for me is in part trying to get that cash level down. We just got to get it down. I gotta stop being so timid about it. Part of my issue with that has always been not trying to add too much to one specific company all at once, and trying to kind of tiptoe into a position. And so what I try to do is I try to have a handful of companies that all at one time I am able to like pick and choose this company to put a little bit in this day, this company to put a little bit in this day, and then kind of do that on a daily basis. Adding a couple more companies to the portfolio is good for that in that sense. So like, for example, right here on my portfolio dashboard, actually marked in orange right here, the companies that are both undervalued already in my portfolio, and companies that I'm under allocated to. So PayPal, I'm slightly under allocated to. In mode, I'm a little bit more under allocated to. Skyworks, I'm very under allocated to, but unfortunately, it's that one's the least of the undervalued, so that one I'm a little bit more hesitant to add to. But the point is, I could theoretically add a little bit more to it too. And then the new additions, New Gold and Silver Corp, I'm very under allocated to because I just started those positions. So you know, as of right now, I've got 5 positions that are undervalued and I'm under allocated to. I do have other positions I'm under allocated to that just aren't that great of a value necessarily. But the point is that, you know, I try to have a handful of things available to me to pick and choose on any given day, because I like to also buy things when they're on a down day, and sometimes everything's up. That's part of the problem, is some days everything's up. So that's one thing I kind of like about adding New Gold and Silver Corp in particular, is that you know, being that these are mining companies, they actually very often are going up on days the market's down and down on days the market's up. They're only correlated with the market about half the time. So I think those ones might help with that problem a little bit, creating something for me to buy on days where it seems like nothing is actually a good buy necessarily. So so yeah, that's pretty much an overview of a lot of the work I did this week. Pretty happy with a lot of the work I did. And like I said, I have a whole lot more work in front of me to do. Lots of other companies to look at. A lot of them will end up being kind of garbage and not really of interest. Like I said, we ended up screening through a ton of companies just to find a handful of companies to put on our pre-model secondary page. You know, they're not even on the main page. It takes so much sorting, so much sifting, and so much reworking before a company ends up on the main page. But the point is, I really thought that this process was very successful. It really seemed like it worked by producing some solid results right out the gate. Though, like I said, we'll have to see how well those investments actually turn out in the future. So anyway, did want to actually talk a little bit about those investments a little bit. Like I said, because obviously I added 2 companies to the portfolio. One of them I also added to the dashboard, though like I said, I might make a video on 1 or 2 of them maybe at some point in the future, but also make some comments on them a little bit right now. Like I said, I made a model for Premiere already, which is pretty good. I'm still kind of working through a few of the details of it, but it's enough of a model that I was felt solid enough that I could actually use it within my DCF template. A lot of the stuff that's coming out of it, I'll probably tweak it a little bit before actually, like I said, maybe make a video for this one. But they provide a lot of very useful information in their filings, including information related to their industry and projections of their industry for the future, as well as breaking down the revenues into their different segments, and then giving the segmented information all the way down the line through their operating expenses, their capital expenditures, their assets, and stuff like that. So I was able to essentially create cash flows and project cash flows by their segment, which is a super high level of detail, which on one hand, that's really great because it means I was able to make a super robust model, I think, but that could make it difficult to make a video, unfortunately, because the part of the difficulties of making videos is that I'm usually trying to pack a ton of information into a relatively short time frame, because my videos are already longer than a lot of people on average like to make videos on YouTube. And so I'm always trying to kind of like find ways to make my videos a little bit shorter, because I think that will help attract more people. But at the same time, I'm trying to pack tons of information and make it understandable and comprehensible. So I don't know. Obviously, I like making charts and graphs and stuff to maybe help with that. So maybe that'll help with it. But the point is I think there's an interesting opportunity for Premiere, and I think it could be maybe a good video, but it honestly could be maybe a hard one to make. So we'll see what happens with that one. But point is very happy with the model that I came up with this week on that one. So, but we'll move on from that one. Like I said, I think I probably am going to make a video on that one, even though it is going to be difficult. So I'm kind of going to talk a little bit less on that one right now. But we will also talk a little bit about the miners, Silver Corp and New Gold. We'll talk about New Gold first. New Gold is the one that is, in my opinion, a little bit of a lower risk play, and maybe not as good of return opportunity, though it's a pretty good return opportunity. It kind of depends on how things play out. But the point is when it comes to gold, gold miners operate in a lot of the worst parts of the world. So, there's usually a large amount of geographic and political risk associated with companies, which means higher discount rates, which means lower valuations. So that's usually a huge problem for gold mining companies. And the sweet spot is to maybe find a really good opportunity in a more friendly jurisdiction, a legal jurisdiction where you don't have to deal with the idea that one legal regime is going to change and they're going to change their tax laws pretty abruptly and stuff like that, and complications related to that. So I was really excited to find this particular company, and one of the reasons I consider it to be a relatively low risk opportunity is because of its geographic diversification, which is to say it actually doesn't have any geographic diversification really at all. It's entirely focused on Canada, and that's actually a non-geographic diversification that I like, because Canada is a region that, in terms of natural resources, I'm not super concerned about. It's not the most perfect governing location, but it's not the worst governing location either, and it's also very, very close to the US, both physically and through legal ties as well, that makes it so that in particular U.S. citizens and residents, I feel, can feel very, very confident about cooperations between those legal regimes in a general sense. So that is to say that property rights between American and Canadian citizens, I think, can be basically considered affirmed and well understood. So the point is, yeah, finding a good mining operation whose entire mining operations are entirely out of Canada is pretty interesting, pretty cool. Usually when I've looked at mining companies in this particular geographic location and focus, usually they're not that great of an opportunity. Now, I said gold, it isn't mostly a gold miner, but they do technically do a tiny amount of silver and a little bit of copper. It's like one of their locations is pretty much entirely gold with a tiny amount of silver, and then the other location is mostly gold, a tiny amount of silver, and then a decent amount of copper. And then also within that location, the New Afton mines, they've been expanding some of the locations in that region, where they've actually found some new deposits of large copper gold ore. And something that you kind of like learn when you pay attention a lot to both the copper and gold spaces is that copper and gold can often be found separately, but in some circumstances they can be found together. And oftentimes when copper and gold are found together, that's actually a sign that you find really, really large deposits. So the fact that they found this pretty significant copper gold deposit in the New Afton mines gives a lot of people pretty high confidence of some of the future potential discoveries that they could find as well going forward in the future. Now, my evaluation for the company doesn't really assume a lot of those future assumptions. We're, for the most part, assuming that they're just going to have the next 10 years of production and then a relatively tiny amount of a multiple on the further end of it to capstone it, to essentially say that whatever their expected life of their mines, which is currently around like 15 years or something like that, that would actually be effectively the life of the perpetuity, or not a perpetuity, I should say. It's not a perpetuity. It's more like a 15-year annuity on the cash flows in terms of like how the valuation is done. But the valuation still ends up looking pretty good regardless of that point. So they are expecting to have significant increases in their gold production over the next year or two. So, but if we then just assume that production remains even from that point on going forward for the next decade, and then, like I said, tapering off for the last 5 years thereafter, so essentially about a 15-year life, the valuation ends up looking pretty good. Like I said, on my main page right here, you can see that I end up seeing about 30% of upside, 15% expected returns. And that's, like I said, with a terminal multiple of 8, because that's kind of what I'm talking about. A very, very low terminal multiple to imply that effectively there's a short life of the mine after the 10-year projections. But anyway, that's New Gold. Like I said, I kind of wanted to talk about them first because I didn't want to necessarily get into as much of detail related to them. This presentation I'm looking at right here gets into a lot of the specific details related to some of their mines, but as I was kind of already talking about, they're expanding some of their projections in their Afton mine, which they're expecting to go into commercial production of those new zones in this year, 2024. So it should be pretty good to see that production coming online. In terms of like the total level of production, like this is the first phase of the mine within that region, and they have the second region that came in right here, and then the third region is the region that they're going into right there. So they're expecting to get their production levels increasing all the way up through the end of 2025, and then that would be basically the steady state from that point onward. So pretty interesting opportunity, and like I said, relatively low geographic risk considering it's just a Canadian operator, and so I'm pretty excited for that opportunity. Now, let's talk about Silver Corp, the other one. This is one that I think potentially could be a much higher returning investment, but there is some risks to it. So, or some more risk to it, because there's risks when it comes to any mining company. But I'm very interested in this one nonetheless. This is another Canadian company. However, they don't operate in Canada. So this one definitely does have some geographical political risks. And this one is a Chinese operator instead. That they're building. I don't know. It might be their building. It might also be just like some stock photo or something. That's a good question, but who knows? That's not. I'm not sure, to be honest. I see some Chinese characters right here, so it could be. But anyway, yeah. So like I said, it is a Chinese operator. So this one, well, not Chinese. It's a Canadian operator, but it's Chinese locations. They operate pretty much entirely out of the Yin Mine District. You can see in the Henan Province, as well as the GC mine districts in the Guangdong province and the Hunan province as well. So pretty significant portion of the silver production comes from China. I think it's supposed to be, I think, like 10% of the global silver production comes from China. And then if I'm remembering correctly, it's like, I want to say 50 to 60% of the global silver processing is done in China, meaning like the smelting of the silver into processed ore. Which if you guys remember, we kind of covered that similar concept when it came to copper. I remember when I was doing the copper presentation, we saw similar kind of percentages, although I think it's less copper mining is done in China, but you have even higher smelting levels done in China. That's kind of what I'm saying, commenting on, is that China is like the smelter of the world. So a lot of ore is sent to China to have the smelting done there, and then the processed ore is then sent back out of China to go to other places. So anyway, the reason why I mentioned that though is because that is one of the reasons that having the mines in China is super beneficial, because it creates really close proximity between the smelters and the mines themselves. Like, they don't actually have to ship the stuff overseas to get it to the smelters in China. They're right there in China in the first place. So super low cost production scenario for them. Super high levels of profit per ton. This chart is kind of useful of information, so I kind of want to explain it, but it's actually kind of a little bit confusing in my opinion too. They have the realized price of silver on the right axis right here, which is the purple line. So you can see this is the silver price over the course of the last 8 years or so, relatively flat up through 2019, and then 2020 it jumps up right here. But then on the left axis, they have the per ton value for their ASIC per ton, which is essentially a sustainable cost of per ton in order to maintain their production levels, which you can see in general has maintained a pretty consistent level ever since then. And then also they have their profit per ton, which is the green line right here, which is below that line. The point is to show that their costs have remained incredibly stable even since 2020, when the prices of silver have gone up. So they've been able to have a much more significant profit margin ever since then. And then obviously a lot of people say, well, what if silver prices come back down? But in general, I don't really think that's necessarily super likely. Coming down here, they have this cool chart that compares their EBITDA margins and return on equity compared to different groupings relative to their peer group, which I'm not really sure which companies are in their peer group necessarily, but presumably a bunch of other silver companies. 22% for their peer group, which is the gray dotted line you can see right here, Silver Corp being the red, as well as the industrial ETF for Vanguard being the yellow line right here, 15%, and then GDX, which is the global gold and silver miners ETF, being 38% in the blue. So in general, Silver Corp has higher EBITDA margins against all of those groupings, the closest being GDX, which in general, gold mining has higher margins than silver, so it shouldn't be too much of a surprise for that. Silver Corp in general doesn't have too much gold going on for that. It's for the most part just silver, although we'll get to that because that's going to be changing in the future. That's actually part of the story, part of the narrative, the thesis for this particular one. Return on equity they have included right here, not against all the same groupings, but at least against their peer group. Higher returns on equity in all of these years, except for something going on 2020 or 2013, 2014 right there. So let's see, skip down a little bit further. I think, oh, well, they also include their valuation against their peers. Super cheap. EV to EBITDA, 3.5%, which I'm not a huge fan of EV to EBITDA, because I think that if you're going to do a multiple, you probably want to include operating expenses or capital expenses as part of it. And so DAW is a kind of a proxy for that, in my opinion. But whatever, nonetheless, it kind of works for this nonetheless. 3.5 versus 16. We could assume that even if that was affecting things by like a factor of 2, then maybe Silvercorp should end up being like 7 versus 16. They would still seem super cheap under that basis. Oh, actually, now that I'm thinking about it, right here, it shows some of the companies that they would be including in the peer group: Fortuna, Endeavor Silver, Pan American, Hecla, Coyer, and First Majestic. Then price to adjusted earnings, I'm curious what the adjustments are right there, but 13.9 for Silvercorp versus 90 for the peer group. I think the 90 average for the peer group is a little ridiculous, but maybe it would be better if we had a median or something like that, or maybe if it was not based off of a year where there was a huge earnings compression or something. I'm kind of curious what's going on with that. Price to operating cash flows, 5.6 Silvercorp, 32 for peer group. I think we're probably having some cash flow suppression maybe going on right there as well. Curious on that. But either way, the point is super cheap, super underpriced. Again, that's one of the reasons that it was brought to my attention in the first place, and then I started looking at it and then found it to be pretty undervalued as well. Okay, so now getting to their recent transaction that they just closed on an acquisition that is actually pretty transformative. And one of the reasons that I'm actually very interested in this one, because if I was just valuing them off the basis of their silver business, I think that they would be probably more like fair value, especially if you're taking into account the risks of operating in China. Then if I was being even more conservative, beyond just kind of more appropriate risk assessments against China, but against the fact that I'm actually pretty I'm pretty negative on China myself, so I would end up being probably more conservative in terms of like what margin of safety I'd want for them, just because of those China concerns. But their new acquisition that they're going through is transformative, in the sense that it's going to be changing the type of company that they operate and also where they operate, because it's going to be diversifying away from China as well as away from silver as a metal. They'll be diversifying towards gold, which everybody should already know. I'm pretty interested in gold. We already discussed one gold operator that I invested in already, and I already had another one in my portfolio. So this would be adding more gold exposure over the course of it, which works for me because I actually have more of a longer term thesis for gold and a little bit more of a shorter to mid-term thesis for silver. So the idea of taking a silver investment that then diversifies itself away from silver towards gold actually really works well in terms of kind of like my macro perspective on both of those metals as well. But the point is they recently purchased this company, OreCorp, which was an Australian explorer that had done a lot of the exploration and the geological work in Tanzania in the Lake Victoria region, where there's a large amounts of gold fields, where other major producers such as Barrick and AngloGold, Barrick being the gold miner that I already had in my portfolio before this year, they already identified pretty significant regions of gold. They've already had all the geologists do all of the work and identify the resources, and they've already paid all of the government permits. So they're basically just getting ready to mine. They just need the capital to start building the mine and start drilling the operations themselves. And so that's where they came to Silvercorp for. Basically, this Australian company decided to sell themselves to Silvercorp. And then that becomes a new kind of combined company for both of them. OreCorp gets the capital resources they need in order to develop these resources in Tanzania that they've located, and Silvercorp then gets to diversify away from China as well as away from silver, which creates a much larger runway of resources for them going forward, especially in terms of thinking about the eventual drying out of the resources in China eventually. Even under the best of circumstances, there would still only maybe be like, I don't know, 20-25 years or something more of operation in that region, maybe 30 or something like that. But the point is, under worst case scenarios, you could assume much less than that. And so being able to diversify into another type of mining in a different region makes a pretty big, significant difference. Now, the numbers that the geologists seem to project is ranges of up to 234,000 ounces of gold annually, which is pretty substantial. Like I said, this would be a huge transformative deal for them. This would end up making the lion's share of the revenue come from gold mining. happening eventually, and they're not expecting to actually get production really rolling until like the second half of 2025, as they're talking about right here. So probably not even going to get revenues from this until 2026, which would be another reason why they would be considering them selling themselves to another company, because that's a pretty significant amount of cash flow bleed to deal with up until that point, and they may not have been able to deal with that. So this is pretty interesting deal. Silvercorp I consider to be pretty cheap on as a stock themselves, and so the fact that they actually made this deal through issuing essentially their shares, they're essentially diluting themselves, is one negative to this aspect. But what that does is it creates the ability for Silvercorp to hang on to their cash pile, because they themselves don't have any debt but do have a significant amount of cash, and then that puts them into position to essentially already have all the capital they need to develop this mine going forward. So it maybe isn't necessarily being done on all the most optimal financing circumstances, in my opinion. But considering the kind of the macro climate we're in right now, I think it's actually pretty prudent of them to be doing this deal the way that they're going to be doing it. But at the end of the day, Silvercorp is going to have 82% of the shares of the combined entity, with OreCorp having 18% of the previous combined entity. And then, like I said, gold production would be ramping up in 2025, expecting to be reaching revenues in 2026, with the silver production being also ramping up over the next couple of years, increasing their own capacities. But then at that point, they'd be starting to diminish at some point in the future. So it's pretty neat opportunity, in my opinion, because I don't think the market is really pricing in this opportunity at all. Like I said, I made my projections for the company a little bit, but I've heavily handicapped my projections for the company. But it really seems like the market isn't really taking into account just how much gold is in terms of this deal. Yes, it's several years away, but the silver business is such a cash flow business already that they're going to be having such significant cash flows just coming from their silver business for the next couple of years, that it's not like the business is like a negative cash flow or all the way till 2026 or something like that. It's like, really, this is just a really neat way for them to replace their silver business over the course of the next decade. But the next decade of silver is still a huge right portion of their business. Like my valuation that I have on the dashboard right here, it should be understood. I'm pretty much assuming that they only get up to like half the levels of the gold production that they're promising, and I'm also assuming that the silver business is gone at the end of 10 years. If not just because the silver dries up, but maybe the macro environment between the US or Canada and China gets worse, and so maybe for some reason they're no longer allowed to operate there. Like that's, in my opinion, like a true worst case scenario, is that like China doesn't allow foreign operators to operate their silver mines for some reason or something like that in a couple of years or something like that. Like maybe they make some crazy decree like that, which I don't even think is likely for the record, but that's like, in my opinion, the worst case scenario. So unless they do that before 2026, I don't think it has that big of an effect on Silvercorp. And then at the end of the day, like I said, it comes down to just how much of this estimate you think is true. They say right here, could deliver average annual production of 234,000 ounces. Like I said, I found it to be significantly undervalued, even if you assume half that. If it's still a pretty reasonable valuation, assuming they still have silver portion of their business, even if it's a quarter of that. But like I said, even if you assume it's half that and the silver portion of their business is gone in 10 years, it's still a fair value. So if you assume it's even closer to this number, and they still have portions of their silver business, then it starts to become a really significant opportunity to it. So yeah, I don't know. We'll see what goes with that one. Like I said, I have it heavily handicapped right here. I also have New Gold heavily handicapped as well. The way I'm looking at it is that as both of them start to successfully show some of the things I need to see in terms of those things, like I need to see Silvercorp, I need to see a lot of the capital expenditures go into the Tanzania gold mines, and I need to see like them actually start to really dig in there, and then maybe when they start to show first ore, we can upgrade as well. And then I also need to see that the margins on the silver business sustains themselves for the next couple of years, because obviously everybody's expecting all sorts of economic concerns or something like that. So
economy goes into a little bit of a downspin, that could mean lower margins for miners, as there's going to be less demand for their product in the short run, since silver is an industrial metal. So it's possible that they could have a really bad year or something like that. But in general, Silvercorp is supposed to be some of the higher margin producers. So in general, we should see how that performs there. So the point is I'm heavily handicapping these two, but they could have both be upgraded at some point in the future. Keep in mind, for example, right here, terminal multiple 8, terminal multiple 9.9. Lower than average, lower than median in terms of at least the ones that I have on the secondary page, which you can see, for example, the secondary page, the average and the medians being around 10 and a half for the terminal multiples that I'm putting on these ones. Those ones are much more conservative than the terminal multiples I put on my main page ones, being 15, 16, 18 to 19 for the weighted average one, but that one's going to be so heavily influenced by the $1 trillion boys club. But yeah, 15 and a half for the terminal multiples I put on these companies versus 10 to 11 that I put on these companies. You can see I'm in general already being more conservative on this secondary page. It's kind of like I said, me just kind of testing the water page. That's what this is. This is me kind of just putting a feeler out on the value for some of these companies. But if it looks interesting enough, we might take a snag at it. But the point is if I undid some of the conservatism that I had on the Silvercorp valuation right here, it could be worth double what I have right here easily. It's pretty high potential returns, I think, for the Silvercorp one, which is one of the reasons I kind of felt like I had to pull the trigger. So anyway, that's kind of all I really wanted to say about those miners for today. Like I said, maybe I'll make a video on the Silvercorp. Maybe I'll make a video on Premier. Like I said, I already talked about that one a little bit. We'll see what's up with that one. If you guys are in there in the chat and you guys have suggestions of stuff to look at, maybe you could start throwing them out there. Maybe we can go take a look at some stuff on Ticker. Or if you're looking at this list, maybe you have ideas of something that you want me to look at right here. I will say, if you've watched up to this point, live or on the replay, I'd really appreciate it if you like the stream. Please subscribe to the channel if you haven't already. Hit the notification bell. Also, consider joining the free Discord. The link is in the description below. It's also the pinned comment in the chat. But the free Discord, you can join to be part of the group where we have daily discussions of what's going on in the market, what's going on in our portfolios, the actions of major investors, and other stuff like that. So come be part of the daily discussion there. Scott comments, JPM earnings next week. Yeah, that's right. We're getting the first round of some of the earlier companies for the earnings season will begin. Some of those bigger financials. Yeah, I saw that you posted like that little short list. What was it? Yeah, here it is. JPM, UNH, Bank of America, Pepsi, Wells Fargo, BlackRock, INFY. I can't remember what that one is off the top of my head right now. BK, WIT, DAL, ACI, SNX, JEF. Yeah, so lots of the financial ones like to report a little bit earlier. We'll see what happens with them. Yeah, I do think Schwab comes not too long after them. Peak UNH. Peak a little bit. Yeah, so and then actually was let me come back over here. I'm trying to remember if UNH ended up being one standard deviation above or not. It might not have been. It looked good in the large cap grouping, but I think maybe when I did it on the healthcare grouping, maybe it didn't. I thought it did. Or maybe I already took it from this short list right here, but whatever. Come back over to the take a look at their estimates first. So we're expecting high single digit for the next 2 years. Yeah, Humana's there. Definitely been seeing that one in there. Well, maybe we have to take a look at that one. So yeah, so upper single digit growth. They had double digits for the last couple of years, or well, it was expected. We'll see if it actually what actually stuck the landing there. So yeah, I mean, on average, we were getting double-digit growth or something like that over the course of the last decade, right? Looks like a little bit above. If I had to guess, it was probably like 10, 11% or something like that. For the next couple of years, we're getting high single digits, so they're expecting a little bit of a slowdown in terms of that. We could go in, look at the ratios, gross margins, EBIT margins. Not very high gross margins on an absolute basis, around 22 to 25%. But for the industry, I think that is pretty typical. I don't think that's super atypical for their industry, but I'd have to look pretty closely on that. EBIT margins also, it's kind of the same comment. I think that's actually maybe a little bit lower than some of the other players in the industry, if I remember, but I'm not entirely wrong. I think there's a pretty wide spread in insurance. There's like plenty of like 1-2% margin players, and then there's a few double-digit players, if I'm remembering correctly. But in health insurance, but mid-single digits, yeah. I think insurance in general, on average, is around 10% or something like that, if I'm remembering correctly. Pretty high asset turnover, which is good with the low EBIT margins. 1.5 on average, or 1.25 to 1.5. That's pretty good. I'll get rid of the gross margins. EBIT margins was down a little bit for 2014 through 2016, and then it came back up. It was going up a little bit before the run up in margins that everybody else has been experiencing, so that kind of seems to speak to maybe some sustainability in that trend, but could be wrong on that basis. If we take a look at return on assets against it, we'll get rid of the return on assets is not as high as we would like it to be. We really prefer to see return on assets at least into double digits, but it kind of depends on the composition of their balance sheet a little bit, just how we think about that. Yeah, they have a lot of investments, so that's going to drag down the return on assets a little bit. So that does make me be a little bit more lenient towards them in terms of the return on asset number. They just sold off some Brazilian units, sold for way less than they bought, I think. Oof. Let's see if we can spot it in the numbers anywhere. I don't know how big it was, this portion of their business, but yeah, it doesn't necessarily stand out. It might have been a smaller chunk of their business, but either way, small losses add up. So if he's selling it for less than than they bought it for, then either way, 600 million, yeah, not necessarily the biggest of impacts on a how big is this market cap? $500 billion business. Yeah, geez. Anyway, let's come back over to those estimates. So yeah, single digit growth is what it is. EBIT's expected single digit growth as well, a little bit higher. EBIT margins are expecting to kind of sustain at the higher end of what they've been, closer to 9% relative to the kind of like 7s and 8s that we were seeing previously. So they're expecting EBITs to sustain that kind of upward trend that we were seeing a little bit. Could be doubtful, but in the long run, I could believe it. Free cash flows, a little bit more ebb and flow, it seems, in the free cash flow margins as they're kind of like showing it right here. But looking pretty solid for the next couple of years or so. Let's come over to the valuation. Averaging 14 for EV to EBIT and 18.5 for the PE ratio. And they're currently at 19.5 for the PE ratio and 15 for the EV to EBIT. So a little bit of upward drift, could be the upward drift could be them being seen as a little bit more competitively sustainable. However, we were also seeing rising interest rates, so we didn't see any downward drift for that reason, which is not exactly what we like to see. But obviously, I know you were looking at the downward drift comparative to here, but over the long run, yeah, it's a little bit of an upward drift on that valuation. Definitely. Who else we want to compare them with? CI, Humana, Cardinal. Yeah, they look kind of pricey relative to their UHH. Oh, you're just saying, gotcha. Yeah, yeah, not super great, not super great. A little pricey it seems. Humana though, maybe we'll have to take a look at Humana. PE 15, EV to EBIT of 10. And then as we were saying before, that one was on the underpriced list. So maybe we'll have to take a look at Humana. Maybe. Olga has BHG. Oh, I don't know why it wasn't at the top of the list. Gotcha. Yeah, usually if it's if there's like a American Stock Exchange one, it pops it at the top of the list. I'm not sure why that one is up there first, but gotcha. Yeah, I wasn't familiar with BHG, so I was like, wait, which one? Who was he talking about? Did I get rid of my grouping? Oh, it did, didn't it? Oh. Oh, so this one hasn't been trading too long, it looks like, BHG. It's a newer one. Unprofitable in the short run. Interesting. Let me actually go look at it. I should have just stayed at the page while I was at it, but double-digit growth expected this year and next year. After huge declines of this last year, I'd be curious what was going on with that. EBIT margins expected to climb to profitability by 25, but be unprofitable this year. And then free cash flow is negative for both years. Interesting. Former United Healthcare CEO founded it. Interesting. Interesting. Well, I wish you the best of luck on that one. Definitely looks like a little bit more of a speculative opportunity, but there could be something there. Could be. Anything else? What else do you guys want to look at? I can show you guys a little bit. You're up over 100%. Woo, nice. Nice. How long have you been in it? Hydric struggles. So this is one of the other employment industrial ones that I was looking into. This is one of the ones that it looks like has the best opportunity out of the ones that I've screened through. Consulting on-demand talent searches to businesses and business leaders worldwide enables clients to build leadership teams by facilitating recruitment, management, and development of senior executives. On-demand services to provide clients independent talent, including professional leaders, functional expertise, stuff like that. Few months, woo! Doubled down a lot. So yeah, I'm gonna assume you were down 50% before you were up 100%. Is that one of those classic stories? Had to watch it drop like a knife a few times first. I mean, that's my experience before I ever have good returns, for the most part. Anyway, Hydric struggles. Not the highest of margin business either. As you can see, kind of single digit business. Also strong drift upward over the course of the last decade. You can see actually relatively flat over the course of the kind of period where we're seeing other companies have higher margin movements. So the curiosity is whether or not this is the fluke or this is the fluke or what in between. But even if you kind of average 5 to 6% or something like that operating margins, so not a high margin business. It's just kind of consulting relative to you know, gross margins. Gross margins a little bit of a decline right here, but I kind of curious to see whether that's more about transformations of their business, because gross margins related to consulting, I'm kind of curious like how they define the difference between the gross margin portion versus the operating margin portion relative to like say a product company. I'd have to kind of like look into their statements a little bit more to kind of get a feel for like what's going on with that. But if you compare, for example, their EBIT margins and their cash flow margins, you can see they're pretty much in line with each other. So very, very capital efficient business consulting. It's like not the highest of margins, but you don't have to put a bunch of capital into the business over and over and over again. You pretty much get to keep it. Keep my eye on K&W for March if you're into health/biotech. I'm not super into biotech, but I will perhaps keep an eye on that just out of curiosity of what you're talking about. We'll see what's up with that. Anyway, come over to the estimates. Relatively moderate growth expectations over the next couple of years, just low single digits for the revenue. Margins expecting to be sustained as well. Free cash flow margins expecting to be relatively strong as well, as we were seeing in general. Free cash flow is at least as strong as margins, or as the EBIT margins it seems to be. And then coming over to the valuation though, that's where things start to get fun, because we have a company. We have a company with EBIT margins on average of 7.5 and PE ratio on average of 17.5, where they're currently 3.5 and a little bit less than 9. So we have EBIT margins and PE ratios where they're half as much as they've been on average over the course of the last 10 years. Obviously, like I've said, we like to adjust our PE ratio assumptions for the differences in interest rates over the course of a period of time, but halving of it is not usually necessary. So that means in general, this baby is definitely cheap relative to its historic average, as well as pretty low multiple, just kind of in general. 3.5 for an EV to EBIT, 9 for a PE ratio, comparative to other consulting businesses, which often do trade at like 10 to 15s in that kind of range or something, in kind of like a kind of sustainable level. So pretty low, pretty cheap. Like I said, not necessarily the highest of margins, but a relatively strong cash flow generator within that margin space nonetheless. So yeah, this is the one that has the highest level of undervaluedness on the dashboard. You can see right here, not including, for example, like I said, the fact that I'm being relatively conservative in my estimates right here. If I wasn't being as conservative, we might see Silvercorp as the highest potential returner on here. But even in terms of like what I feel reasonable about putting right here, like I said, I see this baby as maybe 80 to 83% of upside, and that's with a terminal multiple on there of about a 12. So yeah, technically that implies a little bit of some revision right there, but even some revision on that level of multiple change would still only be like 30 to 50% change in the valuation. I've got 80 right there. So a decent portion of it comes from just the operational level, not just the valuation level as well. So yeah, Hydric and Struggle, interesting company. I know I had seen this one come up on screens many times before, like on the Magic Formula website. I'm pretty sure I'd seen this one pop up before, but I've always kind of shied away from consulting companies. Because I feel like a lot of them don't provide a lot of really useful KPIs for putting together models. But I'm going to at least give this one a try, give it a look. We'll see what we can come up with. Okay, Olga, give us some more thoughts on that KNY or KNW in here. They have ex-Eli Lilly executives hired. They're going to compete with Dexcom/Abbott. Bio RFID diabetes monitor. Fitbit manufacturer will build their device. Finally funds buying into it. Vanguard with a small position. Non-invasive glucose monitor device. March is the biggest diabetes event in Italy. As expected, they show their final product or a lot more details concerning their devices. Interesting. No Labs. This is the company you're talking about. Focuses on development and commercialization of proprietary biosensor technologies in the United States. Proprietary platforms include Chroma ID and Bio RFID technologies that utilize electromagnetic energy along the electromagnetic spectrum to perform analytics. Interesting. Almost no coverage, which shouldn't be too big of a surprise, I suppose. In fact, it's no coverage because this is from many years ago. That's funny. I just like going to that page usually first, but as you're kind of talking about them getting stuff out now, it makes sense that they wouldn't really have a whole lot of coverage. They don't even have really any finances, just some expenses from the last year, it looks like. But let's see what kind of expense drain they're dealing with. 14 million or 14 million in operating expenses. 15 including some other random crap and stuff. The balance sheet looks like 8 million in cash. That's pretty much all of their assets, is just the cash. And 4.5 million in liabilities. Okay, so they definitely need capital within the next year. So yeah, let's see. Hopefully they're getting stuff going in March, as you were talking about. They don't have really any runway. Interesting. Well, I mean, like I said, maybe I'll keep it on the radar just to kind of see if something pops up on it, but it definitely doesn't look like something that I myself would necessarily get into. Maybe if they had like a cash pile for a runway or something like that, maybe I would, but interesting. So anyway, I think that's going to do it for today, though. Appreciate you guys coming to chat with us. I'll ask one more time before we go. Anybody who's watching live or on the replay, please give us a like. Please like the stream. Please subscribe to the channel if you're not already. Please hit the notification bell if you're already subscribed. Please join the Discord and all of that. Like I was saying before, as I was kind of talking throughout the stream, I did the model on Premiere, so who knows, maybe I'll work on that one a little bit more, get it a little bit more robust. Maybe I'll make a video on that one, or maybe I'll make a video on this interesting Silver Corp transaction opportunity. Like I said, there's a very interesting opportunity there, so potentially maybe those could be some of the videos that I'm working on at some point in the near future. But either way, you guys can always throw me your suggestions in the comments below, or you can join the Discord and message me on there some of your suggestions. So I'll catch you all in the next valuation or in the next live show. All right, bye.